Hello, everyone, and welcome to our webinar today. Our topic is on the new legislation that passed at the end of last year, the Secure Act 2.0. As we go through the presentation, if you have any questions, I have the chat and Q&A box open for you. We're not going to be able to go through everything that the Secure Act entails, but we're going to focus on some of the important pieces that we feel pertain to most individuals. So let's get started. For those of you who may be new to our firm, our mission is to help clients achieve financial peace of mind by preserving and maximizing intergenerational wealth. A little background on us: we have over $2.1 billion in assets under advisement, working with almost 1,200 households. We're a registered investment advisor, which means we're an independent fiduciary advisor working in your best interest. We custody our assets at Charles Schwab for your protection, and we're a fee-only wealth management firm. We've been growing over the years. Here's a quick snapshot of our advisors. If you'd like to learn more about each one of us, you can find our profiles on our website. We have a full operations and financial planning team in our Virginia and Texas offices as well. And we manage our investments in-house and also work with the local CPA firm in Texas to help our clients with their tax preparation needs. For those of you who work with us, you know planning is at the heart of what we do. Most people think that planning for retirement is just about the investment management piece of it, but everyone's situation is different, and it's important for us to focus on your goals and manage the issues that are important to you. If you're new to Bogart and have not gone through our planning process, I encourage you to reach out to your advisor or myself, and we can talk specifically about what you and your family are working towards. So let's get started. So what exactly is a Secure Act 2.0? The Secure Act was passed on December 23rd of last year, and it stands for setting every community up for retirement enhancements. It improves and expands upon the Secure Act of 2019, giving broader individuals more resources to save and plan for retirement. One of the biggest changes to come out of the new legislation is the rules regarding required minimum distributions. The required minimum distribution age has now been raised to 73 beginning this year. For those that were born 1960 and later, their age has now been changed to 75. As RMDs keep getting pushed later and later, it's important for us to review your financial plan to determine the impact of what these changes might mean to you. One of the other components of the RMD that you might not have been aware of is the penalty for not taking a required minimum distribution. So effective in 2023, failure to complete the full RMD amount will now be fined 25% of the unfulfilled RMD amount paid to the IRS instead of 50%. So previously, for an example, if an individual's RMD amount is $100 and they only took out $50 of their RMD, you would have been charged 50% of the penalty. So now, because of the new fine, if you have an unfulfilled $50 of your RMD, you will only be fined 25% of that as a tax penalty. And the legislation eliminates required minimum distributions on Roth 401k plans as well. So individuals are no longer required to take RMDs on your work-based plan Roth accounts. What this means is that if you had left an employer and you had pre-tax as well as Roth dollars within your 401k, your plan administrator would calculate what your RMD was on the whole amount. And so due to this new distribution enhancement, you are only going to be required to take out the pre-tax part of that. For those that are charitably inclined, there's also been a few changes. Retirement savers can now make a one-time distribution to a split interest entity. Now, this might be relatively new, doesn't pertain to a lot of individuals, but what it means is that investors can now make a one-time distribution of up to $50,000 from an IRA to a charitable remainder annuity trust, a charitable remainder unit trust, or a charitable gift annuity. Previously, these distributions always counted as ordinary income. So now you have this one-time distribution that you're able to take up to $50,000. In regards to the amount that's allowed for a qualified charitable distribution, or what we call a QCD, the amount is now going to be indexed for inflation, effective in 2024. So currently, the maximum amount, $100,000 that can be taken as a QCD from an IRA, will be adjusted depending on rates of inflation starting next year. It's been $100,000 for the last several years with no changes. So this will be a nice change given all of the current other inflation adjusted numbers that we are being given. Retirement plan limits have changed the way that they're going to be increased every year as well. So catch-up contribution limits are going to be indexed for inflation starting next year. You'll notice as we kind of go through this, lots of things are effective now. Some things are effective in 24, 25, and a little bit later. It is going to take some time for plan administrators and some clarity on some of these changes that are brought forth by the Secure Act to be able to put into place. So effective starting next year, those contribution limits are going to be indexed similarly to work-sponsored catch-up contributions, and they're going to be done in $100 increments. Something that's also relatively new and might catch people by surprise is that catch-up contributions for individuals who make more than $145,000 are going to have to be made as after-tax Roth contributions within their plans. An additional annual 401k or similar plan contributions can be made for individuals age 60 to 63 to their work-based retirement plans effective in 2025. There's going to be a contribution minimum of $10,000 for 401k plans and $5,000 for simple plans. And again, effective 2025, lots of ambiguity, lots of us figuring out what this means for changes as well. I just got a question that came in on asking if these materials are going to be posted. This webinar will be posted online as well, and there are some other Secure Act documents that are posted on our website as well. So no need to frantically try to take some notes here for these. And so now on to the many changes that are taking place within the 401ks and IRAs. These enhancements are optional only at this time. And again, it may take a while for employers and plan administrators to implement. So effective now, employer matches can now be made to Roth accounts. Previously, employers were limited to pre-tax only. Now, if you elect to take your employer match as a Roth match, you'll have to recognize this as income in the year that you take that. Matching contributions for qualified student loan repayments will start in 2024 as well. There's going to be, again, an administrative component of how something like this works. So it will take some time for employers to get these set up. A question came in that says, is the $145,000 joint? That is actually individual. So that is considered you as an individual for the Roth contributions. So if you make more than $145,000 individually, then those contributions will have to be made as Roth. Another question came in here, trying to get through that. I think qualified charitable contributions from an IRA can only be made direct to charity, not to a charitable remainder trust. So this is one of the new stipulations that is coming into play. So you are correct in the sense that qualified charitable contributions do have to be made directly to a donor advised fund or directly to an institution, but they are now being given a one-time $50,000 option to be able to send those directly to those charitable remainder trusts. So it's going to be something that is very particular to those individuals who own those annuities. Lots of other distribution rules as far as 5% distributions have been made every year to charity in order to make sure that those stay current. Now, Savers Match is something that most people might not know about. It's a government-funded contribution to eligible retirement accounts, and you must meet certain criteria to be eligible. So it's currently known as a Savers Credit, and so it's only issued as a tax credit. So you had to have a tax liability in order to receive any of these funds. Again, for some of the low to moderate income families is who this pertains to. So starting in 2027, this will convert to a matched contribution into an individual's retirement account. So the goal of this, and you'll see the goal across the whole board of Secure Act, is to get households to begin saving for retirement. So this is something that, again, doesn't take effect until 2027. And so lots working out all of the ambiguities of where does this go and how does the person prove as far as their eligibility and those kind of things there. And the savers match currently is not refundable, but will be in 2027 because it will be a match. So if you didn't owe the tax liability, then you don't get it currently, but because it will become a match in 2027, it will make it eligible for those individuals. There are a few limitations. So again, ineligible individuals are those who were under 18, if you can be claimed as a dependent. So these might be like college children who are being claimed on their parents' taxes, full-time students, and individuals that exceed the thresholds that are being set forth as well. Believe it or not, participation is relatively low in company-sponsored plans. And so in order to get people to save for retirement, there's a few new legislation requirements that are being created under this legislation. So one of them is going to require employers to automatically enroll employees into new work-sponsored plans, effective in 2025. So a few things that this criteria has to be met. Default savings rate must be set to at least 3%. They are to automatically increase the annual savings rate by 1% until a minimum of 10% and maximum 15% of the individual's income is reached. And employees can opt out of the program. Now, this is not going to be required for plans that existed prior to December of last year. So it is only going to be on new plans that are started. Government plans, church plans, and employers with less than 10 employees or have existed for less than 3 years, and simple plans are going to be exempt from this automatic enrollment requirement. Somebody just asked if there's still an income limit when you cannot make Roth contributions. Yes, there are still income limitations on Roth as well. No big changes as far as huge increases. So they have steadily been increased with inflation. And so that is still the current pace of those income requirements for a Roth. For any part-time workers that we have out there, they have now reduced the eligibility requirements in order to participate in your workplace plans. Part-time workers who previously were not allowed to participate may now be eligible due to the new rules. So the new rules state that workers who recorded a minimum of 500 hours for 2 consecutive years requires their employers to participate in a retirement savings plan, effective 2025. It was previously 3 years under the Secure Act of 2019, and it now extends to 403B plans, but does not look backwards towards any work services before 2021. Linked emergency savings accounts. This is part of helping employees with their financial health by enrolling them in a savings account. Studies show that most people, if faced with a financial emergency of $1,000, will not have the funds to cover it. So this is going to allow employers to automatically enroll employees into emergency savings accounts effective next year. The current highly compensated employee amount here, because it says it's not eligible for non-highly compensated employees, this is currently at $150,000. So if you make under $150,000, employers can automatically enroll you in this emergency savings account. It will be linked to an employer's plan, but if you make over 150, you are not eligible to participate. Employers are going to be given the option to auto enroll their employees up to 3%. And the limit is going to be $2,500 into the emergency savings Roth type of account. Employers are going to have a little bit of control over what they're able to establish, and anything above that $2,500 goes into your traditional retirement account. Military families, this is relatively new as well. So military families move quite frequently. And so one of the things is that spouses are never actually there potentially long enough to qualify for a retirement plan. And so they are giving a tax credit to employers for providing immediate enrollment to military spouses into their retirement plans. So a few criteria, it's for employers with 100 employees or less. Military spouses must be non-highly compensated employees again, and they must follow the following provisions. Military spouses must be eligible for participation within 2 months And they have to be treated as if they have 2 years of service following participation. You'll see this because in some retirement plans, there's a vesting period of time and you have to be there for a certain number of years before you're entitled to contributions and matches. And so they're vesting you within 2 years of service. And retirement savings plan is immediately included in all employer contributions. And it's a $200 per eligible military spouse tax credit that the company will be given. We don't see these very often, but wanted to just mention a few rules have changed for simple IRAs. Simple contributions by employers have usually been 2 or 3% depending on the plan. And so just wanted people to know that this gives them an additional contribution by the employer, and simple IRAs now have a Roth contribution, a component as well. So if you have one of these plans, it would be of interest to note that there are some new levels of contributions that you were able to put into here. This one is not for individuals, but rather for the retirement plan itself. Currently, retirement plan administrators have the ability to self-correct errors that are made on their part within the plan. The Secure Act 2.0 just expands some of these self-correction and permissible failures that might happen and allows the plan to get those done without having to do any additional filings. And a few of the issues that the IRS is taking up with that is missed or incomplete required minimum distributions, distribution to non-spouse beneficiaries, and specific plan loan mistakes that might happen. Secure Act 2.0 contains some provisions designed to fix issues by the original Secure Act. And one of those was a new rule that allowed business owners to establish a solo 401k retroactively, but it only permitted the employer contributions after the end of the calendar year. So this limitation made it difficult for small business owners who were attracted to the structure, yet wouldn't be certain about their earnings for the plan year until the next year rolled around. The Secure Act fixed this glitch, and it allows retroactive employee deferrals up until your tax filing deadline, not including extensions. So for instance, like tomorrow, if you are a solo business owner and you have a solo 401k, you are able to actually make retroactive employee deferrals all the way up until tomorrow's, for instance. Now, again, this is only effective for plans that started after Secure Act 2.0 to be able to make that deferral. Again, a very random type of retirement plan that we typically see. But if you are a contract worker or have a small business and you have these 401ks, or you're looking at wanting to open one of these solo 401ks, then something like this would pertain to you. I'm not going to go into the details regarding this slide, but just know the rules for those who have elected 72T on their accounts have changed. So 72T is when individuals have chosen to take distributions out of an IRA prior to age 59.5, and we are trying to avoid that 10% early withdrawal penalty. Previously, we had to, once we set these up, we had to be very aware of transfers in, rollovers, making sure these distributions were continued every year. It's been a few rules that have eased on this. So if you're currently taking any kind of 72Ts, please reach out to your advisor just to see if any of those pertain or may impact what your distributions are. For those that have made a traditional or Roth IRA contribution and you realize that you did not qualify to make the contribution, then there's been a slight change to any potential penalties. A lot of times this happens when individuals, they get large bonuses or they just get unexpected compensation towards the end of the year or get a new job, and now suddenly they have made IRA contributions that they are not eligible to make those contributions previously before. So now there's no longer a penalty on distributions of earnings on excess contributions in retirement savings accounts effective immediately this year. Both the excess contribution and any earnings from that contribution must be distributed by October 15th of the following year for which the contribution was made when fixing the excess contribution. And any earnings made from the excess contribution will still be taxable, but are not going to be subject to a 10% tax penalty. Statute of limitations pertains to when the clock starts for the IRS coming back to you on certain issues. Previously, there was a specific form 5329 that had to be filed to begin your statute of limitations. And so now the statute of limitations starts immediately upon filing your 1040, or if you are not required to file a 1040, the due date that would have been required to file. So some of the things that people miss is RMDs, as well as the excess contribution penalties. And so it's 3 years now for missed RMD penalties and 6 years for excess contribution penalties. So again, get that clock rolling just by simply filing that 1040. One of the biggest changes, and perhaps in my opinion, one of the best changes that the Secure Act is the 529 rollover to Roth options. So this is really sparking lots of conversations that we're having with our clients on what to do with additional funds that are left over in the 529 plans, or if now maybe the conversation might change in the sense that you might not want to use the 529 plan dollars because you might want to save it for your child's Roth IRA. Now, there's some criteria that have to be met in order for this to happen. And we have not been told all of the reporting in order to get all of these things done. Again, it starts next year, so we still have the rest of the year to get all of that taken care of so that we know how to proceed with these starting next year. One of the biggest criteria is the child still must have earned income. So we cannot take these dollars out of the 529 plan and open a Roth IRA if the child does not have earned income. So that is still going to be a requirement. Now, the Roth IRA must be under the name of the beneficiary of the 529 account, which means that if your son is the beneficiary of the 529, then it is your son who must have that Roth IRA. The 529 plan must have been maintained for a minimum of 15 years. So if they have been opened within the last 10 years, we would just have to wait another 5 years before we could transfer any of those dollars into the Roth. There's no end date on these 529 plans. So if we need to continue to hold these in order to meet that 15-year requirement, we can still do that to get those funds into the Roth. The maximum lifetime rollover is $35,000 that we are able to do. And the annual rollover amounts are still subject to the annual Roth contribution limits. So it will take a period of years if we had the full $35,000 left over to be able to get that into the IRA. So again, this is lots of planning is going to have to go around this to find out the minimum of 15 years. We're not able to touch the last 5 years worth of contributions. So there's going to have to be some more reporting that we are going to have to keep track of, as well as probably the 529 plans are going to have to start keeping track of the contribution vesting. A few additional enhancements that are pertaining to Roth IRAs. If you have a SEP or simple IRA, they've now added the Roth after-tax contribution as an available option. Again, this is for typically our small business owners here. And so you're able to add that as a Roth component. Again, contributions are going to be included in your gross income for the year. There might be a few hesitancies for some of these plan adoptions to change a little bit. Again, lots of paperwork processes to change some of these, and the IRS is going to provide some additional guidance for the Roth component of the simple and SEP plans. So then therefore the employers have to get new adoption agreements out and get those out. So again, take a little bit of time, but these are effective immediately. Some other additional enhancements, again, employer contributions are now eligible for Roth IRAs effective this year. Again, the biggest change to that is if you are having your employer match in a Roth component, you're going to have to recognize that as gross income for the year. So again, one of the things to talk about when we're thinking of our overall financial planning, where do we want to have our dollars for retirement? This will definitely come into play as far as the elections that we choose. It does not apply to profit sharing contributions, just matching and the non-elective contributions. Employer Roth contributions are required to be non-forfeitable, meaning the employee will always have the right to claim those contributions. There's always been early withdrawal penalty exceptions, and so now those have been expanded. So I'm going to go through a few of these just to kind of bring some awareness so that you just know what's out there. So again, an early withdrawal penalty is prior to age 59 and a half. It was subject to a 10% penalty unless an exception applied. These are typically first-time home purchase, some medical expenses, a few of those that most people are familiar with. So now the Secure Act expanded these exceptions to emergency personal expense, terminal illness, domestic abuse, paying for long-term care insurance premiums, and recovering from a federally declared disaster. So go into a little bit more detail with each one of these. The emergency personal expense exception begins next year. The maximum distribution is $1,000 per calendar year. You have to repay that within 3 years. And the contribution and or deferral amount to the retirement savings plan must exceed the previous emergency withdrawal amount. Terminal illness, it allows individuals to withdraw from the IRA and employer retirement plans effective immediately. Distributions must be repaid within 3 years of the withdrawal as well. And the definition of terminal illness is now going from a 24-month rule life expectancy to 84 months or 7 years. Again, any of these things are going to be very plan specific. We're going to have to speak with your plan administrator to find out exactly how all of these exceptions are handled within that plan. Domestic abuse allows victims of domestic abuse to take distributions from their IRAs or employer retirement savings plans starting January of 24. The maximum distribution limit is $10,000 or 50% of the vested balance. The distribution is limited to be taken within 1 year of the domestic abuse incident, and it must fully be repaid within 3 years of the withdrawal. Long-term care insurance premiums, effective December 29th, 2025, the maximum distribution amount is limited to the lesser of the following: $2,500, 10% of the vested balance of the retirement savings plan, or the payment amount for qualified long-term care insurance premium. It's eligible for spousal coverage if you file joint tax returns. This is one of the options. I would say that typically most people who are under 59 and a half probably haven't purchased a long-term care plan. So again, but this might come into place. I have met a few people who've had these early on. I would encourage people to speak with their advisor when it comes to where is the best place to pay for your long-term care insurance premiums. Federally declared disaster recovery. For those of you who live in Houston, you know that for the last couple of years, we have had areas that have been federally declared disaster areas. So we have had a few of these. One of the biggest difference with this now is that Congress is no longer going to need to pass a special relief for each disaster. So as long as a federal disaster is declared, then this will come into effect. The distribution must be taken within 180 days of the federally declared disaster. The individual's primary residence must be within a federal disaster area, and the lifetime distribution is limited to a maximum of $22,000 and must be fully repaid within 3 years. You also still have, if you are not going to be repaid, you also still have the 3-year rule to where you can break up that distribution if it is going to be a taxable amount to you with no repayment. So what is not included in the Secure Act 2.0? The backdoor Roth or mega backdoor Roth contribution limitations. Currently, there are no limits for using this strategy. I know that this is always a concern for individuals of whether or not this is going to be something that is eliminated by one of these legislations that gets passed. There was no indication that there was any changes to the backdoor Roth. There are no restrictions on who can make Roth conversions as well. Previously, 10 plus years ago, you had to make within a certain income limitation before you could do a Roth conversion. There are no income requirements. Anybody is eligible to do those Roth conversions. Restrictions on qualified small business stock stay the same if that pertains to you. Qualified charitable distributions can still be made at age 70 and a half. This is one of those that was a little quirky when they first came out with the Secure Act 2019 and the required minimum distribution had changed. One of the questions was, are qualified charitable distributions only starting when the RMD comes into effect? And that is not the case. And so qualified charitable distributions can begin outside of your IRA at 70.5 still. All information on the 10-year rule for beneficiaries of inherited IRAs currently remains the same. And new types of investments, privately held investments, are still eligible to be purchased with IRA funds. No changes in regards to that. And so that concludes our presentation today on some of the various components within the Secure Act. Again, lots more details as far as what was actually included with all of those. This was just the highlights of typically what we see most of the time that would impact most of our clients. So if any of this raised some red flags for you or made you think about, does this pertain to me? Are there any changes that I need to be aware of? I would encourage you to reach out to one of your advisors here at Bogart Wealth, to myself. We are more than happy to discuss these with you.